Welcome to Wall Street Beats, everyone. Good morning. Happy Friday, last Friday of July. I believe it's almost August. I am Steve Lamar. I'm joined today by Ben Bry. What's that nickname they have for you? I heard on Twitter, Ben? Whole wheat and rye, or corn.
Oh, you mean Levinson?
Levinson. What is
Pastrami on rye.
Pastrami and rye.
On rye.
I like that.
His nickname is Pastrami on rye, so you can remember it's not Ben Bray, it's Ben Bry.
Yeah, there we go.
And David Mackey, David Maris.
Wow.
Wow.
Jeff-
We're on fire this morning. Good.
A compliment and an insult at the same time. I don't know how to take it.
All right, so why don't we kick it off with Ben, who had some interesting thoughts this morning on what we're about to see next week.
Well, yeah, we can start there, and then I have one other thing.
Okay.
I sent Steve this chart this morning, then I just posted it out. Brent Donnelly sent this in a Bloomberg chat I'm on, which is a good summary. You can check my Twitter out. And then I also did the earnings whispers, which does a nice summary with all the icons of the earnings. So, there's a huge macro week and there's a huge earnings week, all jammed in one final, end of July, early August period.
Hard to watch.
That was pretty hard to watch.
That photo reminds me, when I was a teenager, I got into a car accident, and it was clearly my fault. I kind of fibbed a little bit about it to my dad, and he brought me to where it was, and we walked it probably 30 times. Each time he's like, okay, so tell me what happened here.
Tell me, yeah.
And it was that face that I was making that Jay Powell had.
Yeah, and it was like your dad scolding you, and then being like, "Come on, buddy, let's go."
Well, if there was any question about him quitting after that exchange, there's no freaking chance. If he's going to tolerate that, he's not quitting.
I don't think he's quitting, and I don't think Trump was ever serious about firing him. Someone explained it to me that, hey, he's just like Coach K working the refs. In college basketball, where those guys are just getting in the refs, they're just working them. And I feel like that's kind of Trump's strategy. If you look back, now this is the second administration. So we've had him for 4.5 years as president of our country. He likes to just wear you down, just wear you down. And I think that it's in some senses trying to neutralize Powell in his last, 9 months, 8 months, whatever it is. But it'll be interesting to see what they say. I mean, you look around and you see some weakness in the bottom 60, 70% of the consumer. And I passed around a chart yesterday, which one of the better pair trades I saw as a way to play this low-end consumer. And here in Wall Street Beats, we've talked about that for ad nauseum. Right? I don't know how many of these shows we've done and in our chat talked about, the bottom of the consumer is not doing very well. Well, I think when we saw Chipotle get crushed this week, that was a good example of what we're talking about. Chipotle raised rates or prices a lot to the point where, a burrito, a beer, and some chips are like $22 now, right? Or something like that, which is absurd.
More like $30.
I can go to Chili's and get some baby back ribs, and for about the same price. And so short Chipotle along Dollar Tree, Dollar General, Five Below, 50% since April, which is an unbelievable pair trade. And so you just wonder, this push and pull of the economy's not rolling over as quick as some thought, but there is weakness very clearly. I'm of the camp, just so everyone knows, that rates are going to be going back down towards the zero bound. The Fed just actually released a paper talking about worries about the zero bound. I don't know why they're doing that unless they're worried about it. So it's kind of this weird situation where it's kind of easy to see where we're going. When you think about a company, and this is probably relevant for this week as we've had the return of memes and speculative stocks to the max, unprofitable. Open Door goes from $1 to $5 to $2. We had our, Kohl's, which Jeff Mackey and Berna talked about on here occasionally as just a troubled retailer, but that thing rips 30%. So we're seeing some
in GameStop, and it's like,
get
it on.
So
Zero DTE, the biggest volume ever was the other day on zero DTE options. It's just
so you bring that up, and it's like that they Open Door, but Kohl's, where it's going, and I have learned that shorting these things very difficult, because like AMC in January of 21, my ex-partner and I got absolutely destroyed shorting that thing. We had a large short. We were long the junior bonds as an offset, but basically we're short gamma. Well, these gamma squeezes can be absolutely violent. And so, it's coming back to the rates. It's like, I know where they're going to go. It's just a matter of get from here to there and the sequencing of all this that really matters. That's why we're here, and that's what, where the money's made. But, it's nice to have
So that's why you like you like that other small W.
Yeah, that's what I was going to talk about. So just to finish off the week, and then we can talk about that. Okay. And then you have jobless claims, PCE, and then jobs. But then, you have Meta, Apple, Amazon, and that Wednesday, Thursday, Visa on Tuesday, which will be a good read through for spending. It's just a lot. It's going to be.
Isn't this all about liquidity in the QRA? And if they cut coupon issuance by a meaningful amount, then it's game on for equities. Dollars getting crushed. Bonds are probably
maybe, but don't you think a lot of that's in the market? I think there's an expectation of that. I think when you look around,
I think that's the tricky part, especially as it relates to equities, right?
I have a chart that shows the Senate gets a report every month at the beginning of the month showing the weighted average rate, the composition of the debt. The bills thing, it was at 22% in the height of Yellen's bills issuance. We're back down closer to 20 now, which is where the TBAC kind of likes to keep it at. Yeah, look, a T-bill's much more money-like. T-bill's like much more money, so you're lowering the duration of the liability portfolio. And I understand how that, but I think there's just two things. There's the understanding of it, and then there's the memory of the last time when they funded with bills. Let's just remember, though, when that set off that, market rally, well, in October of 23, we were at the lows, okay? We were at 4,200, staring back at the lows, in its face.
A good point.
So, the market looked real dire in the, bond market. The curve was all above 5%. So it's tough to say.
That was a good time to juice it. This is probably not such
that was. But here, let's go to the rates, though, because, I like to talk about interest rates, Steve. We even got you to start trading SOFRs this year. I talk about
Maris to sleep here.
All right, sorry, David. We're going to talk about some stocks, though, to tie it all together. Yeah, let's pull up that chart, Jen. All right, so speaking of pastrami on Bry, my buddy Dave Levinson always bugs me because he doesn't have a Bloomberg, so I'm sometimes collaborate with him on charts, and we think through some stuff. This is the blue line is the mortgage spread versus the 10-year Treasury, and the red is the MOVE index, which is basically you can think of the MOVE index like it's about 83 right now. That's the basis points daily, or annual move in basis points. So if you do the daily, you divide it by 16, and so you're kind of at a 5 basis point rate, and then the red line is adjusted by the VIX. But the point is here, mortgage spreads follow volatility. And so this chart clearly shows that. You have rising volatility, you have rising mortgage spreads, falling volatility, falling mortgage spreads. So independent of where the base rates go, because we can all sit here and argue about that, I think they're going lower, but you also can have mortgage spreads coming down. And so if the front of the curve, which, just won't move at all. We're just in that 3.75 to 4% bucket, and it bounces around, but it won't take much but a couple negative jobs reports and the short end will be lower. Even if the long end's a little slow to come down, you're going to have the floating rates start to be a contributor, basically. And the one thing about this cycle that was really weird relative to last cycle is everybody who had money and access to capital, whether you were Apple or you were just a rich boomer or whatever, everyone turned out their debt, right? And so the normal transmission mechanism, especially of a rate hiking cycle like this that was so fast and furious, it just took a while. And in a weird, perverse sense, it actually helped the people who were on top. Because if your liabilities are at 3% or 3.5%, and now
turned out you don't care about interest rates going up, they don't affect you at all.
You actually want interest rates to go up. It makes it harder for competition that doesn't have access to capital, and you can sit there and do the T-bill and chill and like get 5.25. Now it's 4.25. So you're actually making the spread on the bank in some senses, right? So that's maybe one of also the contributors to this K economy thing that we started off with, is that the bottom 60, 70, both in companies and in households, right? Because look at the IWM just being complete underperformer. Well, there's a much more rate sensitive component to the IWM and in the smaller companies. The big companies don't need capital. They generate a ton of cash. So it's just it's a big positive for them. As we go forward, earlier this week, I got a little excited. Rocket Mortgage, a stock that Steve and I both own, had a nice move this week from 13.75.
19 handle on it.
Oh my God, it had a 19 handle in the overnight market on Wednesday. I'm sending Steve, was like, oh my God, look at this. And then I woke up and then it was 16.25 and now it's sub 15. So, and UWMC, which is not nearly as good a story as Rocket, it's a smaller cap, but it's a little special situation because the CEO is kind of sitting on it with one of those program stock sales, hey,
10B5 just pounding it.
It's not that liquid, so he's really dunked on that stock and put his foot to the neck of the stock, if you will. So that's just another play, and I think once that stock sale goes down, if the general trend where these stocks will work, that can be up 50 to 100% pretty fast. Now it's smaller cap, but it's not, Again, Rocket's a company that's very interesting for a longer term. They closed the Redfin deal. Mr. Cooper deal's still outstanding, and Mr. Cooper's the number 2 mortgage refi home, guy. So there's some deal dynamics there that you should be aware of. But assuming that gets done, they're 33% of the mortgage business.
They're a monster. They're just sees and the tech
play.
And the management team is just is fantastic.
Yeah, it just strikes me as like, I was talking to our buddy Charlie Peabody, and I was like, maybe you could fund a long Rocket with a short JP or a basket of short JP, short Bank of America, short Well. Yeah, exactly. Yeah. Right, because I think these guys are going the right direction. And look, this is nothing against those banks are short. I just think the banks have had a really nice run, and what I'm talking about here,
they're very fairly valued here.
Lower mortgage rates, lower mortgage spreads is very bad for banks. Okay, and a flatter yield curve is bad for banks, and lower rates are bad for banks. Okay, so banks are sitting there and they've been getting the benefit of all this Powell action that we've lived through for the last 3 years, plus now the cherry on top of Trump kind of deregulating the SLR, which, by the way, I'd like to take credit that Charlie and I were talking about that on our macro show in May of 2024 when no one was talking about that they would do that.
Because no one understood what the hell you were talking about.
You said it, Steve. I didn't say it.
To be fair, Andy Constant was on here and he thought that we were crazy, and look what happened. But anyway,
so let's talk about one more of yours, Ben. Weight Watchers, and given David's affinity for HIMS,
talk about Weight Watchers.
I'm curious to see what David thinks about your HIMS.
So just real quick, everyone knows who hasn't listened. Weight Watchers came out of bankruptcy, wiped out about 70% of their debt, trades at 4.5 to 5.5 times pro forma EBITDA, depending on a few assumptions on that. It's a $38 stock. Doesn't trade. When I got Steve to start buying it, he texts me, this thing trades by appointment, Ben. What the hell? Understand, this is actually an interesting stock for a retail guy or smaller PA trade. And just for anyone who's never traded a post-reorg equity, understand that there will be guys who are the former debt holders sitting there at the offer. And so there will be liquidity here in the sense of if you want to get some stock, you can buy it and they'll sell it to you. But, they're not going to, I don't think they're in the business.
Keep your limits out there.
They don't want to smash it, but they also aren't going to let it run because they don't get any credit for it. So I don't know, right. David, let's talk about a little bit, it's a weird dynamic because they don't really have much revenue growth because their behavioral section is declining. It's stabilizing a bit, but it's declining, whereas their clinical is up 50% quarter over quarter and year over year. They did a deal with Wegovy, and I think, David, that said they did a deal with Lilly as well, right?
Yeah, so I haven't dug into it. I do own a little bit based on your owning it and your...
Appreciate that.
Well, and also you've made me money before, so
Well, let's keep it right.
I should say I made me money before because I put the money in, but your ideas have made me money before. Steve asked, like, so what's my overall view? I haven't dug into it, so take that with a grain of salt. But you and I were talking about this yesterday or the day before. I like platforms. I like the name, like it's a great brand name. And as people are starting to navigate this whole GLP-1 thing, trying to get an endocrinology appointment, that's one of the reasons that HIMS is doing well, is that they're taking away a lot of the friction of dealing with the healthcare system. Weight Watchers does that too. I don't know how high touch a model they are, but getting an endocrinologist to call you back or to get an appointment is tough enough. Do you really think that the average one is going to call you, see how you're doing on the drug, check in on you weekly or monthly? Do they have an app? How many people here are listening have a doctor that says, "Oh, download my app and I'll keep track of what you're doing"? And I imagine that Weight Watchers has that. Maybe they don't, and I'm shooting myself in the foot on that. But I have to imagine that companies that are either digital first or that are getting up to speed are going to help a lot of people navigate. GLP-1s, people kind of understand what they are, but they still need to be monitored by a doctor. So the idea of going to a doctor for a health checkup, getting through all these hoops of should you have it, shouldn't you? A lot of people are just saying, you know what, I know I'm 30, 40 pounds overweight. I need this. I want this drug for weight loss. I don't have, I have diabetes. I have other risk factors, cardiac risk factors. They know those things, but they don't want to take time off of work and all the rest. So I think I like the idea a lot. Now the question is, can they execute? Because they've had a couple missteps, right? They've tried to reinvent themselves a couple times.
Yeah, the new CEO was the president and CFO of Shake Shack before this. So, we'll see. I mean, I think that
maybe he has the list of Shake Shack loyalty members. She just
target rich environment.
I'm only joking. Clearly, Shake Shack wouldn't allow someone to take that list. I'm only joking.
But I guess the point is, right, I think this is a wildly appropriate stock to talk about, because if you guys go back in time, this was a meme stock at one point. Oprah, let's go back, I think it was like 18. Yep, 18. So in 2018, the stock went from $9 to $110. I remember this. I wasn't involved at all, but I remember watching it, very entertaining, because we didn't have nearly as many meme stocks back then. That wasn't like a general feature of the
probably
market.
One of the first, right?
Right, and so it was, a lot of people, but it was because Oprah jumped on. They gave
the Oprah effect.
Yeah, exactly. But again, I talked to my mother, who's in her 70s and a candidate for GLP-1, and she has sleep apnea, and she's like, yeah, I would be interested through Weight Watchers, because there's a like, to David's point, I think there's a brand trust of a huge customer segment that are kind of the people you would think would be taking it. You know what I mean? And so, yeah, we'll see what happens. Again, David's point's very right. Like, execution is all that matters.
The other thing that I like about it is it's also a play on a trend that I think's already happening, is that there's a race to the bottom on the pricing of GLP-1s. So if you could get a Rolls Royce for $30,000, there'd be an unlimited number of Rolls Royces on the road. The reason they can't do that is, right, that the production cost is higher than that.
Then it wouldn't be a Rolls Royce. Right.
Yeah, there wouldn't be a Rolls Royce. But that said, GLP-1s, the profit margin is very high, and the pressure coming from competitors and the race between right now two very comparable drugs, where I think Lilly's drug is a little bit better, but just say they're comparable. It's kind of not a race to the bottom, but there's pressure to lower price. That helps all of the telemedicine because it's going to open it up to more people.
Yeah.
All right.
So I think it'll be really interesting to see like how it all plays out. But I guess my point about it is if all these other crappy, garbage stocks are ripping, and this thing has a new growth avenue, and it's just not. It's a unique thing because it's post reorg, but people know the name, right? This is a well-known brand. Whether it still matters or not. I think for consumer discretionary stuff, the boomer brands are really struggling, because if you think about the life cycle of spending, well, what do you spend more money on as you get older? Healthcare, right? And in your health, like, you spend a lot less money on brand new sneakers and all the new furniture and that kind of stuff. So anyway, I like it. Ticker WW. Everyone on this panel owns it. So we are talking our book here.
We're talking our book. Okay.
Well, we always do. I mean, that's kind of what we do. So,
That's true.
I mean, we put money behind it, so we believe in it.
Not investment advice. Not investment.
Yeah, I don't want.
This is what we're doing.
No, just talking our book.
Yeah.
All right, Mr. Maris, what else are you looking at today? I see Sarepta is crashing again.
Yeah, well, I mean, that's people have now say because they said they weren't going to take the drug off the market. Now they're taking it off the market. So everyone's saying like, well, why am I here? I was here before for you were helping people with muscular dystrophy. Now we don't know what your future is. You might face an existential issue. And so people are just out. I mean, that's just really what you're seeing. I think it's just follow through. Now I want to talk about, you mentioned next week is a huge week in earnings, and it really is. It's like a monster week, and for people who are going to trade, it's not what I do a lot, but there always are opportunities where something pops up ahead of time or afterwards. The one that I'm watching, I do want to talk about a few things. So first on TEVA. TEVA is a really frustrating stock because for the longest time it has gone down on up days and down on down days, and it's just, I think it's worth $25, and that's a simple 10 times earnings. It's not looking at it for this quarter. I don't want to say that I'm going to be out. If they don't deliver, I'm out, but I kind of feel that way. That's usually a time when you should say, oh, I'm going to buy more because you're so frustrated. Other people are in that same boat. Every other investor is going to do the same thing. What I like though, going into this quarter, and I don't have it up, but the EPS consensus number between the high and the low on the street is only like 3 cents, 4 cents. I like when there's a very narrow dispersion. It either means the company's managed that well, they've communicated it well, they've contacted analysts. They can't really do that anymore nowadays, but they find ways of making sure that it's a very narrow range. And that makes for any surprise much better. Now, it also makes a negative surprise just as painful as it would be otherwise. And another way to think about that is you have a whole bunch of analysts, and if they're all at the same number and they beat by a couple cents, it's hard for the person who has a negative view to just be like, hey, they missed it. This is horrible. So I like the setup going into it. I like that it's still
and the expectations is kind of meh, right? So
yeah, that's why it hasn't been a meme stock. It hasn't been, no one seems to like it. I've held on. I think every time I go to hit sell.
So you're saying there's a chance, David.
Well, I say to myself, if you really think it's worth $25, why would you sell this other than just frustration? And it's one that I probably should just try to find a way to take off of my screen, like put tape over it or something.
Leave it there, but don't look.
Yeah, but I like that one going into it. And if there's a negative surprise that's not fundamental, like changing my view, I would add to it. I already own a fair amount, so I wouldn't add a ton, but I like it. I think that it's a nice one.
So if they missed, are you out?
It depends on why they miss. If they miss because they're spending a little extra on R&D, no, because they have a pretty cool pipeline and they have something coming at the end of this year. It's a once daily antipsychotic. It's a remake of an existing drug. The good of that is no one else could do it. At least they haven't so far. And I think that doctors use it all the time. So if you can all of a sudden have a once daily, that's great. So, So I like that one. There are a few others that are reporting. I don't know.
What day?
So they're reporting before the open on Wednesday.
On Wednesday. Oh my. Okay.
A stock that you and I have traded, Steve, that I'm not involved with right now. Dexcom also reports next week, and kind of a battleground stock, but it hasn't outperformed going into the quarter either. So it might also be a good setup. Speaking of GLTR, so many people are using glucose monitors just for fun.
The new fad, even if you don't need it. I'm just going to strap. What do you do? They glue that thing to your arm and set up the app and go.
Yeah. I'm sure some doctor will tell me like, yes, you should do that at some point, but I don't get the appeal of knowing like, hey, you should eat at lunchtime. Or guess what? That ice cream really spiked your insulin.
Yeah. I know when my sugar's going up based on what I'm eating. I don't need an app to tell me.
But it's a good one. It was kind of one that blew up a couple times, and it is a very high multiple stock. So that's why I'm not involved. I might be convinced to put a trade on. But I do want to talk about one other thing that I saw that hit the tape. And just, I'm short Bausch & Lomb and I'm short Bausch Health. I think that long term they're
forever.
Yeah. And I think I don't think individual investors should short stocks. I think it's a tough business and it's whatever. But this one has a problem when they have a product go off patent in a number of years. So that's just that backdrop. But the news I saw was that they added 2 members to their board. And so for investors, I wanted to bring this up, not so much for Bausch & Lomb, but for you to think about when you see this type of news. So their proxy meeting, I think, was in April. So why would you be adding board members here in late July? Plus, you're good. So again, off-cycle board additions and are weird to me.
And this isn't these aren't replacements. These are just straight up.
These are adding. So that's the other thing is sometimes off-cycle replacement is so-and-so's retiring or so-and-so's stepping down because of a family emergency. Usually people don't step down off-cycle unless there's an issue, and I don't mean issue with the company, that they have an issue, that I'm in too many boards. I just want to leave. Usually things are fine when people leave because if things aren't fine, they have to disclose that. That said, here you have Bausch Health announcing 2 new board members, and they're going from 10 board members to 12. Imagine you're trying to have a discussion. 10 people is enough. That's more than enough. For their size company, I would even argue that it's too many. But that said, now you're going to 12. So, where is 10 plus 2 less than 12? I think when you're talking about board dynamics in a company there where you already have Icon has 1 or 2 representatives. I think John Paulson's still on the board. So you have some pretty big personalities, hedge fund people. I'm curious, if I were a shareholder, an institutional shareholder, one of the first questions I'd ask is, what domain experience are they adding? Why are you doing it now? Who's leaving? Because that's the other reason that something could happen is that I want to bring these 2 on.
Somebody's
so that
about
makes
to get
10 when we get rid of another 2.
Yep. Interesting. Or they're buddies of somebody who wants more control.
Well, so that's the other issue. So I don't want to get into it because it's really in the weeds, but Icon announced that he had other shares in the company, other positions in the company that he hadn't disclosed to the company. And I say that, but I want to go back to the news to make sure that I have it right, that was with Bausch Health, not Bausch & Lomb. And so the question that came up when I saw that news to me was, is he making a play for the company or for control of the board? And this would be a way to dilute current members of the board. So you're absolutely right. That's a question that comes up is there a dynamic where, hey, because Paulson, by the way, is quoted in the press release, which is I also found interesting. So there's something going on. I can't figure it out. But my point of bringing it all up is that I should say maybe nothing's going on. Maybe they just think 12 is better than 10. My takeaway is, even if you think that, in my experience, both as an analyst and as a public company board member, fewer is usually better. You don't need more than 10.
Fewer and an odd number, so there's never a tie if you need something to vote on, right?
And these, by the way, the folks that they're announcing, they have really good backgrounds. So I'm not trying to disparage them. I think one comes from Bristol Myers, one came from Viatris. It's fine. I mean, they're quality people. Lastly,
but this is still terminal. No matter, there's no way to rescue this thing unless they're fast.
Lastly, on the earnings for next week, I do own Gene Holdings, which is WGS. They're before the open on Tuesday. Merck is on before the market on Tuesday as well. United Health I'm not involved with, but there are a number of large pharmas next week, so we're going to get a lot of good information. It's a good week. AbbVie is next Thursday.
David, do you try to extract any premium out of this Bausch? It seems like there's some options trading, not as much as you would think for a $24 billion EV, but I guess it's only 2.5 billion market cap. I mean, is this thing have potential they can restructure it, or is it terminal because when it comes off patent they just don't have anything that's going to be able to fill that plug, and then that debt load will just still be there essentially?
Yeah, so they've moved as much debt as I believe they can to outer years, and the last thing they did was do some secured debt with a backstop of Bausch & Lomb stock. So they've so you have these 2 entities, and so no, I think what happens is that they can't restructure it enough to make people comfortable, because the big bolus of debt happens right around the time that they have their big patent expiry. And it's only a few years out. So a lot can happen. And I guess I could, if I had a big enough position, I was worried that somehow they get sold. So maybe I would hedge it. I just don't think anyone wants a slow growth, underinvested in R&D ophthalmology company or Bausch, whatever it is, kind of, no one wants patent expiry risk. So the Bausch, I don't see anyone wants.
Yeah, I'm looking at the debt distribution right now. There's quite a bit of debt that's coming due in the 28, basically. So,
and that's when the generic hits. And I think that the free cash flow, the majority of free cash flow will go away. And so they won't be able to pay it. If they generate, $1 to $2 billion every year for the next few years, you put a dent in some of the debt, but if all free cash flow or the majority of it goes away in 2028, you can't pay those. So if I were a secured late debt holder, I'd be pretty nervous.
Yeah, I mean, they are nervous. You can see those bonds right now. $1.6 billion face is trade with the 4 and 8.875 coupon is at 10.57. Tranche is trading at 10.9. Well, that's an 11 coupon to be fair. But yeah, I mean, it's clear. I think this also, I would guess, especially the Icon, these guys in there, you want to get below the surface on these credit, and see what the credit contracts are saying and because weren't they trying to play a game? Me and you talked about this last year. They were trying to play a game to essentially the equity would steal the assets from the creditors or something along those lines.
I know that there've been suits, or the debt holders are trying to say we don't want you to do certain things because guess what, you're kind of hosing us. Icon and Paulson, I think all of their holdings or the vast majority, from what I understand, are only equity. And I've said it all along, if they really believed in the company, why wouldn't they just do a debt for equity swap? And why wouldn't they just buy the debt? Now, Bausch is doing that, and maybe they are, and I'm just not aware of it, but I haven't seen that anywhere.
Yeah. Okay.
Yeah, it's a good trading style.
It's a
thing moves around, that's for sure.
Yeah.
All right, boys, you want to wrap it up?
Let's wrap it up.
Let's wrap it up. It's 7:40, so we've been
that's enough.
Let's go HIMS.
If Weight Watchers starts working and taking share from HIMS, we're going to have a little inter-Wall Street Beats competition here. Although I guess you're long the Weight Watchers as well.
I think he's longer HIMS than Weight Watchers.
Not much, really, though. To be fair, not much, because I think this quarter is the challenge. This is a make or break quarter for him.
Especially where the stock's trading, 100%. Agree.
We should maybe get Russell back on here at post quarter. Have you guys do?
I think he still has an ice bag on his head from the last time.
I hope he's not still short.
Yeah, it's been a good one.
Thanks, everybody, for joining us. Enjoy your Friday, and we'll be back here bright-eyed and bushy-tailed on Monday. It's going to be a big week. Follow us on wallstreetbeats.com. Follow us on passes/Wall Street Beats, and we will see you on Monday.
Have a good weekend, everybody.
Good weekend. Thank you, gentlemen.